Hey everyone, welcome back to Corporate Decoder. Today we're diving into the Lovesac company's latest annual report, and let me tell you, it's a bit of a mixed bag. It's like that Sactional you thought would solve all your problems, but then you realize you have to rearrange it every time you have guests. We will decode it, but I'm sure some people will love it. The Lovesac company sells furniture, but they sell it with a twist. They have modular couches called Sactionals, and they sell premium foam beanbag chairs called Sacs, and they have an immersive surround sound home theater system called Stealth Tech. They sell these items through their stores and online. They focus on products that are built to last and evolve. They own trademarks to some of their best known product names, things like Lovesac, Stealth, and more. The company also uses the phrase designed for life to explain some of their products. As always, there are risks to consider when buying the stock. A big risk is that people may spend less on furniture during times of instability. They also have issues with manufacturing and importing their products. Not having enough skilled workers, or if they cannot manage their stock levels, could cause them some issues. If their systems fail or they have a data breach, that would cause significant harm to their business. One of the biggest risks is that their reputation could get hurt with increased use of social media. Okay, now for the numbers. We can look at the results of operations. Their showroom sales are $425.8 million, with online sales of 100 in calls and series include pop-up shop sales and other sales, totaled $50K to $4 million. The cost to sell those goods was $282 and $7 million. Selling, general and administrative expenses, also known as SG&A, totaled $281.4 million. SG&A is all of the cost to operate the business that isn't directly selling the products, like salaries. They also spent $88 million on advertising and marketing. The company generated $2.8 million from interest income. The company had a net income of $11.5 million. Looking at this metric across several years, we can see the trend that the current year results are not as robust. They now operate 257 showroom locations, which is up from 230 the year prior. The company believes that customers choose them because of foam fillings, higher quality materials, their design philosophy, and their circle operations that require a distinct level of manufacturing and service capabilities. Also, their high-end branding and social media presence commands premium pricing. The company provided $38.9 million in cash from operating activities. They spent $21.5 million on investing activities. They spent $20.7 million in financing activities. The company has a revolving line of credit, which gives them flexibility to borrow money. They also are repurchasing shares on the open market. The company had to restate some of their financial statements. This means they had to correct errors in previously reported financials. The company was also part of a non-public investigation by the SEC. This can affect investor confidence. If investors lose trust in the financial numbers, the stock price could fall. The CEO, Sean Nelson, set up a trading plan to potentially sell some of his shares over the next year. The company's strategy to reduce cybersecurity risks is overseen by the Chief Information Officer, and they work with third-party experts. The board gets regular updates on cybersecurity issues. The auditor for the company gave a thumbs up and said that the numbers look like they make sense. It's good to remember that the company maintains reserves for warranty claims as they continue to honor their commitments for lifetime warranties. This can sometimes materially impact the financial statements. Overall, Lovesac seems to be navigating a tricky market. The brand has a strong identity and they are trying to innovate with its products. However, concerns about spending, supply chains, and the restatement issues add layers of complexity. For now, Lovesac seems to be on reasonably stable ground, but continued success relies on balancing growth with careful financial management. If you enjoyed this breakdown, hit that like button, drop a comment with your thoughts, and of course subscribe so you never miss another episode of Corporate Decoder.